Towards the end of April, a survey conducted by House Consult indicated that most Kenyans prefer to pay rent rather than take a mortgage because they can neither raise the savings nor access loans to buy houses, a situation that was mainly attributed to the high cost of taking up a mortgage. But according to the Central Bank of Kenya's Bank Annual Supervision Report, the number and volume of mortgages extended between December 2012 and December 2013 went up by close to 16% to 138 billion shillings as at 31st December 2013. The report further indicates that the average mortgage loan size increased from 6.4 million shillings to 6.9 million shillings. 19,879 mortgage loans were taken up in December 2013, up from 18,587 the previous year. Interestingly though, 70% of these loans were extended by just 5 institutions. But due to the high interest rates that prevailed between 2012 and 2013, non-performing home loans increased by 23% from 6.9 billion shillings to 8.5 billion shillings. The report's release comes against a backdrop of a recommendation by a committee headed by the National Treasury to compel commercial banks to adopt a new pricing formula in pricing of loans. New loans issued from next month will be priced using a formula that is based on averages of the monetary policy rate and the 91-day Treasury bill yield over a period of 6 months, according to proposals made by a committee that was instituted by the presidency. It, however, remains uncertain whether the proposed formula will bode well with long-term loans such as mortgages. Denis Otieno, Citizen Live at 9.